Hello, and welcome to the Cornerstone Wealth second quarter market outlook. I'm Jeff Carbone, managing partner at Cornerstone Wealth, joined today by Cliff Hodge, our managing partner and chief investment officer. We will look to email as well as post the webinar to our website and social media accounts. So please share this with family, friends, colleagues, or those you would like to introduce the Cornerstone team to. We're here to provide help and guidance. As we look back on the past quarter, financial markets continue to navigate a complex environment shaped by evolving economic data, changing expectations around interest rates, as well as our new Fed chair. Ongoing geopolitical developments and shifting investment sentiment, while periods of volatility remain a feature of today's markets, the broader environment is also creating meaningful opportunities for investors who remain disciplined, selective, and focused on the long term. Today, we'll review the key developments from the second quarter, discuss what they may mean for the months ahead, and highlight the opportunities we see across the market. Our objective remains simple, and it's not to react to the short-term headlines, but to put the current conditions into perspective, consider how they may influence the investment decisions and the portfolio positioning for you, our clients. As always, we believe in successful investing requires a balance between awareness and discipline. Markets will continue to change, but a thoughtful approach grounded in diversification, sound analysis, and clear understanding of your individual objectives can help investors like yourself identify opportunities while managing that risk. The 3 Ps remain paramount: planning, patience, and process. With that said, I'll turn it over to Cliff for the developments in the second quarter and what they mean for the outlook ahead, as well as the positioning of our portfolios.
After a bumpy start to the year, which saw the S&P correct by about 10%, the second quarter was all about rebound and recovery, as concerns about war in Iran initially pushed up oil prices and stoked inflation fears before giving way to the strongest earnings growth that we've seen for quite some time. The S&P 500 rallied sharply, now up nearly 10% for the year, powered by the AI infrastructure build-out and profit margins at all-time highs. The macroeconomic backdrop is supportive as the global economy continues to expand, the labor market stabilizes, and large technology companies spend unprecedented amounts of money on the AI build-out. The consumer likewise continues to spend, and we're seeing early signs of stabilization in the housing market. The major concern today is inflation. It's a combination of higher energy prices, tariffs, and memory and chip shortages are keeping prices broadly elevated across the economy. These concerns have changed the conversation at the Fed. We came into the year pricing in 3 to 4 rate cuts as inflation eased and the labor market began to stabilize, but have now flipped the script as inflation fears have taken center stage and the market is now pricing in 1 to 2 hikes by year-end. From a market perspective, earnings growth is stellar, at levels usually only seen after recoveries from deep recessions, and profit margins are at all-time highs. Though valuations do remain somewhat elevated, they have softened some, and the broad-based rally that we've seen has been fundamentally driven, largely by the AI supercycle. We're certainly living through some interesting times. From here, the upside in equity markets may be more challenging. Multiple expansion is likely limited, and companies will have to continue to meet and exceed these elevated expectations. Not to mention, there's a highly charged midterm election with which markets will have to contend over the coming months. Overall, we're constructive, but not complacent. Diversification is paramount, as investors should look outside of the classic 60-40 portfolio to help drive returns. So first, we'll start with the scoreboard. The S&P 500's gain of nearly 15% during Q2 ranked as the 12th strongest quarter since 1950. And encouragingly, the rally was broad-based. Small caps, international, and value stocks all participated, with the Magnificent Seven mega-cap growth stocks continuing to lag as the market is now punishing these higher and higher levels of capex spending. Fixed income was steady, but liquid alternative investments were much more interesting. Gold, which usually shines in this type of environment, sold off, while other areas like commodities, market-neutral strategies, and catastrophe bonds were all nice diversifiers to equities. This wasn't just a narrow mega-cap growth rally like what we've seen over the past few years, but a broad-based recovery from an early oil shock. So what's driving all of this? There are three major themes that are top of mind: a volatile Iran, the unprecedented AI build-out, and new leadership at the Fed. We'll take each one of these one at a time, starting with Iran. One word to describe the situation in Iran is turbulence. This has certainly not been a straight line. At the peak of the conflict, we saw almost 15 million barrels per day of Middle Eastern production disrupted. By early July, a formal memorandum of understanding had pushed oil prices back toward pre-conflict levels. Gas in the U.S. fell below $4 a gallon, and vessel traffic through the strait began to turn higher, though not back to pre-conflict levels. And then just a couple of weeks ago, after resolution was nearly in sight, hostilities flared back up when Iran attacked vessels, and the U.S. responded by hitting some facilities inside of Iran. At the time of this recording, oil is now back above $90 per barrel. How quickly this situation resolves is anyone's best guess, but we do know that inflation is top of mind going into the midterms. And there was some good news over the weekend that China may actually pressure Iran to relent, though on-again, off-again activity is likely to continue. When oil prices start to ramp, we think you'll hear more about an imminent deal. When oil sells off, you may see more aggression. As a result, we're maintaining our energy exposure in our equity portfolios and looking to commodities and real assets as inflation hedges. The second major theme is AI and the infrastructure build-out. And here, the spending numbers just keep going up, with estimates now for $750 billion this year before eclipsing $1 trillion of additional spending in 2027. These are massive numbers, which support the strong industrial cycle that we've seen, but it's also stoking concerns about a bubble. The bull case: cloud backlogs across the major hyperscalers have grown roughly $750 billion over the last 2 quarters. This is real contracted demand for AI. And despite all that growth, the hyperscalers trade at their cheapest valuation level in nearly 10 years. These stocks have underperformed year to date, but are starting to look really interesting over a 2 to 3 year time horizon. The bear case is all about capital expenditures, among the same cohorts which continues to balloon to the point where the spending is now outpacing revenue, so free cash flow is rolling over. In fact, just last week, Google reported their first quarter of negative free cash flow since going public, and the stock was punished pretty dramatically after the report. These companies are tapping the capital markets as well to pay for all this spending, issuing nearly $200 billion out of the total nearly $500 billion in AI-related debt this year. And investors are rightly concerned about their ability to generate any tangible return on investments for all this spending. Up to now, it's been the picks and shovels, the semiconductors and the memory producers, which have massively outperformed. But we think the hyperscalers may actually be in a better position to play catch-up over the next 18 months. We'll continue to get more visibility on how AI is affecting these companies' financials over the next couple of weeks. And the final theme that we're watching is new leadership at the Fed. Newly appointed chair, Kevin Warsh, held rates steady at the June meeting, issued a notably shorter statement, and has removed forward guidance for upcoming meetings. He's also established a number of task forces, including around how the Fed will communicate going forward and looking at normalizing the balance sheet. Markets are now pricing real odds of hikes from here, starting as early as September, though we disagree. The most recent CPI report showed the first month-over-month drop in headline inflation since 2020. So we think as long as long-term expectations remain well-behaved, as they have despite all of the oil volatility, and wage growth remains modest, we think that the Fed will continue to look through the energy spike as they have, and that the next move may actually be a cut in 2027. As yields move higher based on geopolitical developments, we think bonds start to look attractive for the second half of 2026 and into 2027. So now onto the macro. Our recession dashboard tracks 12 metrics across consumer health, business activity, and financial conditions. And save for job sentiment, the other 11 indicators all point toward expansion, with both profit margins and housing permits improving over the last quarter. Our indicators point toward low recession odds and are supportive for risk assets into the second half of the year. The labor market is really the one area that bears continued monitoring. June payrolls came in soft, though last week's initial unemployment claim number was the lowest since 1969. So as we said to start the call, earnings have been the major driver of the resilient equity market. Bottom-up revisions, which are real-time company-by-company analyst estimates, have only gone one way over the last 12 months, up. The market now expects full-year 2026 earnings to grow at nearly 24%, and for 2027 to grow at nearly 22%. These are signs of underlying strength. However, they also set a lofty bar that companies will have to meet in order to see continued upside. The Wall Street consensus median year-end price target for the S&P 500 comes in at roughly 7,900, another 5% upside from here. But there is wide disagreement. 7,100 on the low end, up to 8,200 on the high end, which point to very high levels of uncertainty. The good news is that the S&P is keeping pace with rising earnings and estimates, meaning that the rally has been fundamentally driven. But as they say, trees don't grow to the sky, and much will need to go right from here to keep moving higher. Investors should diversify, diversify, diversify. And no conversation would be complete without looking at the risks. And there are four main risks that we're watching and sizing by their potential likelihood and impact. Top of mind is oil-driven inflation resurgence. Countries tapping their strategic reserves and China meaningfully slowing down their imports are two of the main reasons why oil prices didn't go higher, even with the Hormuz disruption. These both buy time, but the longer the disruption persists, the higher odds of upside price increases. The sooner this conflict ends, the better. Next is the AI bull-bear debate. In a scenario where the AI industry becomes more like the airline industry versus a more monopolistic profit platform, we could see meaningful downside in some of these high-flying stocks if the ROI on all the spending doesn't materialize. Third, we flag the Fed. If inflation inflects higher and long-term expectations become unanchored, a new Fed chair may favor a shock and awe approach, where higher rates and higher equity prices would be on a collision course. Lastly is the labor market. So far, so good on this front. But we did get a slight miss on June payrolls, and that sentiment indicator from our dashboard has been red for over a year now. So we're going to continue to watch these developments quite closely. So here's how all this translates into portfolio positioning. We break these down into growth assets, income producers, and diversifiers. The bottom line is that we remain fully invested, but strongly encourage diversifiers to help smooth out what could be a bumpy ride. For growth assets, we remain neutral on equities, with a slight overweight to less expensive value stocks. We also like private equity for investors that can take some illiquidity, as valuations are lower than public markets and there's been less competition for deal flow. With income assets, the main story now is that inflation is eroding the purchasing power of cash, so you don't get paid to keep a high balance in savings or money market accounts. We favor the short to intermediate part of the curve, but are staying underweight credit as spreads aren't currently compensating investors for the additional credit risk. Quality here is the name of the game. Diversifiers sport our highest conviction views. Real assets as an inflation hedge, and illiquid alternatives to smooth out some of the volatility. Real estate, especially on the private side, looks very attractive over the next 3 to 5 years, as valuations have reset and construction costs should keep a lid on supply. So now we'll put this all together with 3 things to remember. 1, not a straight line, but the direction is intact. The Iran conflict de-escalated, then reflared, and we expect continued volatility, not a clean resolution. Yet the underlying economy remains strong, and our dashboard still points towards expansion. 2. Fundamentals have kept delivering and must do the heavy lifting from here. Q2's gain was the 12th best quarter since 1950, backed by an extremely strong earnings season, even as the AI debate gets louder. And then 3, the Fed conversation has flipped from when will cuts resume to could they actually hike? But for now, cooling inflation and some slack in the labor market argue against a hawkish surprise. So thank you all for taking the time to watch our market outlook and helping Cornerstone celebrate 25 years taking care of our clients. Now back to Jeff.
As we conclude our second quarter market update, the message is that markets remain dynamic, but opportunities continue to emerge. The outlook is likely to be shaped by the interaction of economic growth, inflation, interest rates, corporate earnings, and broader global developments. While uncertainty is unlikely to disappear, uncertainty can also create opportunity for clients who are prepared to look beyond the short-term volatility and headlines and focus on the long term. We believe the months ahead will reward selectivity, discipline, and a willingness to evaluate opportunities across a broad range of markets and asset classes. The goal is not to predict every market move, but to remain positioned to participate in attractive opportunities while staying aligned with each client's objectives, time horizon, and that tolerance for risk. On behalf of the Cornerstone Wealth team, we thank you for joining us today. And more importantly, we thank you for the continued trust and confidence you placed in all of us. We appreciate the opportunity to work with you and look forward to navigating the opportunities and challenges ahead together. I encourage you to have a conversation with your team, reach out to your advisor, learn more about how the current market environment may affect your specific portfolio and how your long-term investment goals are coming together. Have a great rest of the summer. Thank you.